Welcome to the Market My STR show, the show made exclusively for short-term rental owners and co-hosts that actually works, so you can stop wasting time and money on short-term rental and co-hosting marketing strategies that don't work. Listen in for tips, tricks, and our book solid, move the needle, and core 4 marketing strategies. Here's your host, Scott Hill.
Hey, welcome back to the Market My STR podcast, another episode with my partner, Jeremy, in our co-hosting business, Auditor. I am going to quickly transition to Jeremy because we have a special guest, and we'll get started with Jeremy and our special guest. Go ahead, Jeremy.
Perfect. Yeah. So excited for today's show. We're going to learn a ton. We have Kris Becker joining us today. Kris is my accountant, and we're going to learn about real estate professional status, and we're going to learn about bonus depreciation and probably some other things. There's a lot of stuff that's being said out in the world, in the internet, that I think may not be totally accurate. So Kris, I think will provide us with a ton of information that if you're interested or curious about how do you obtain bonus depreciation, because it's a huge topic of conversation these days, I think this show will help you a ton. So Kris, welcome.
I appreciate it. Thanks, Jeremy and Scott, for having me on.
Of course. So why don't we start with, why don't you tell us a little bit about yourself, kind of your past experience and, what you're doing now?
Sure. So I spent a lot of time early in my career in various tax departments for businesses anywhere from, 10 million to 2 billion. So did some state, some federal, and some things. Did some public accounting for a while. I've done that a few times over the course of my career. And about the last 8 or 9 years, nine or 10 years, I've been just kind of working, for myself, nothing overly sizable, but just something solid that I've enjoyed kind of working in the real estate market a little bit and working in various fields, construction and, home remodeling and, cabinetry and those kind of things. So I've spent a lot of time dealing with what I'll say is the small business to borderline large business.
Nice.
I also spent 7 years as an internal revenue service auditor. So I spent quite a bit of time auditing clients, auditing small businesses, self-employed up to 25 million, but also helping a large group with some of their audits as well. So handling some of the more sizable clients throughout the country, certainly names that everybody knows and drives by every single day.
Nice.
So yeah, that's pretty much the crux of my career. And now I'm I work for myself and work with just a select group of people that I really like to stay connected with and continue to help over the course of the year.
Awesome. That's great. Yeah, I definitely sounds like you've done a lot. Quite qualified to talk us through this today. The other thing I'll say is it's great you're doing your own thing. I mean, I think a lot of the people that are potentially listening to this podcast are looking to get into short-term rentals specifically to have their own thing, right? To not be working that W-2 and kind of have the freedom, kind of freedom at least that you can build when you have your own business.
Yep.
So that's great. So why don't we hop in? Like I said, the two main things that we're going to kind of talk about are the real estate professional status and bonus depreciation. So both have been tax law for quite some time, but has there been changes to it, and could they change again? Would I guess be my first.
Sure. Real estate professional status is a pretty established tax law that's not likely to change. Real estate professional status and what you have to, the bar or the hurdle that you have to meet is likely going to continue to be the bar for whatever will be the foreseeable future.
Okay.
So the two biggest components of real estate professional status is you have to spend 750 hours within the qualifying activities that are allowable. It also has to be the predominant activity that you perform throughout the course of the year.
Okay.
So where kind of that challenge comes in is a lot of people that are trying to establish themselves as real estate professionals are working 2,000 hours at a job, 300 hours at a job. Well, in order for you to meet real estate professional status, you would have to then exceed that number of hours within qualified real estate activities, which obviously becomes a challenge.
Right. What kind of activities would those be? Like
you're talking about like you could be, in the real estate industry for construction. You could be in the real estate industry for remodeling, for sales, for, just a myriad of things that you're doing within the confines. You could be in real estate management. So you can be in a lot of different areas. Where it becomes a challenge is most people don't meet I have a full-time job and I do more.
Right.
So being a prospective real estate owner doesn't necessarily qualify as a real estate activity. So I can't just say I'm driving around neighborhoods looking at houses to potentially buy houses. I need to have some sort of what we're going to call an activeness within the real estate industry in order for you to be able to count those hours.
Got it. So for me, my current day job is an owner's rep managing construction activities in New York City. So
Now, now you're looking at activity that now you can't work for someone that does that and have those hours qualify. So like I couldn't go work for you,
mhm,
who is a construction manager. I couldn't go work for you and then have that count for me, right?
right.
You can have
Okay.
it count because that's what I do on my everyday. I'm actively participating in the real estate industry, no problem, right? But the challenge is most people can't do that, at least in the beginning of their portfolio
Right. So
build.
if you're a W-2 worker for somebody in that activity, it doesn't qualify.
Exactly.
Right.
And Kris, how is your spouse impacted in this? Is there an impact?
It sure. So if you're filing a joint tax return, only one of you needs to qualify, but then only one of you qualifies for the allowance for losses. So if my wife is not working and she is then going to manage our real estate portfolio, we would have to, and let's just say we set up an LLC to purchase it. She's going to have to be the owner of the LLC. She's going to have to manage the real estate. Her hours are going to have, her hours and activity are going to have to meet the qualification for activities allowable, and she's going to have to meet the threshold of 750 hours. If all that was true, then the ownership portion that she has within that real estate would allow losses.
Mm-hmm.
Now, again, where some people get a little hung up is they'll set up an LLC between husband and wife, and then she'll manage everything and do everything, but she would only get 50% of the losses then because the other owner, which in this particular example would be me, doesn't qualify. So
Mm-hmm.
my portion just gets suspended in passive activity losses.
Makes sense.
So
So, Kris, if I would consider you and me on the fringe of this, I own Market My STR. I founded it. We serve short-term rentals owners and help them market for their real estate. You're an accountant. You serve short-term rental owners. Do we get to qualify? Do those hours count for us or no?
for me, absolutely not. For you, it would depend upon, if are you in the business of property management or are you in the business of company management and then the companies are property managers. So
Okay.
in reality, you don't get the benefit. Basically, you don't get the hockey assist, if that makes
Okay.
sense. So this is more of kind of a basketball analogy where you've got to be the direct assist. So I've got to be directly involved in that particular activity. So absolutely none of my time outside of anything I might do with something I might own would ever qualify me for. I could have 100 clients like Scott and Jeremy, and those hours would never count toward anything associated with real estate.
Okay. So sorry, not to cut you off. So let's step back because we dove right in, right? So they've been around for a long time, both short-term rental real estate professional status and bonus depreciation. We'll talk about what that is here in a minute. But has there been changes to it, and could there be changes to either one coming up? So we said no to real estate professional status.
But to bonus depreciation ebbs and flows based on Congress, obviously, and based on how the law is set up. Bonus depreciation will sunset at some point throughout the course of every single bill. They will always have phase-ins, phase-outs, all those kind of things. So the big, beautiful bill, what everybody needs to know now, is the big, beautiful bill ran up bonus depreciation back to the 2017 or 18 through 22 number, which is 100% for qualifying property.
Right.
Sub 20-year assets, same parameters and rules apply, right?
Mm-hmm.
So yes, the answer is bonus depreciation is not going to be around forever. Bonus depreciation is going to change and get phased out.
Right.
We have timelines for all of those things, but for now, in the foreseeable next few years, you will have a bonus depreciation of 100%.
Right. So in 2022 is when it started to phase out and like 20% drop. So it was 100%.
Yeah.
And then 2023 was 80, 2024 was 60, and it was supposed to phase to zero.
Phase to zero, I believe, in 2027 was the original plan. And obviously, when the big, beautiful bill passed, they
pulled it back to 100. So
in.
right now it's to 100. We don't know a phase out schedule, I guess, at this point.
I'll check and kind of take a look at that and see if they're like what the phase out schedule is for that for sure.
Okay.
I've been working so much with people about the run up of how we're going to handle bonus depreciation, and people are really, really gearing toward cost seg studies and other things right now for sure.
Right now,
There's
Which
quite
also, I guess we'll talk about that, but you do that in house as well, right? You do cost
we
segs.
we definitely have some people that we work with that handle getting all that done. So
okay, all right. So for the foreseeable future until the next I guess, change in government happens,
Yeah.
we're at 100% until it starts to phase out, and then TBD on what happens in whenever a future bill comes down the road for bonus.
Correct. The next two elections will be important, and then whether or not
Yeah.
things stick or don't stick, like again, like we would have said in 2027 it was gone. We would have said that a year ago, and then all of a sudden government changes and they change the
Right.
law. So right now we know for the next couple of years everybody should be geared up, and it is a good investment time. Interest rates are steady or maybe lowering a little bit over the course of the next, maybe 2 quarters, 3 quarters probably, and then we'll kind of see how things go.
Sure.
Hey,
So
Chris-
I don't have any advice to give anybody, but some people do just buy for the tax advantages. Some people it's a bonus, right? So right now is if you're interested in buying a short-term rental and potentially being able to recoup that bonus depreciation, now is a great time to go ahead and buy.
That is accurate.
Chris, just from your perspective, I'm not suggesting you may know this, but I'm just kind of curious. Is this bonus depreciation like a Republican poker chip? Is it significant enough where the Democrats want to take it away because it's so measurable in terms of the impact financially? Or in your eyes, do you see it like it just tends to be a poker chip that gets played back and forth as a way of giving things to each other and compromising?
I'll say I'll go 60-40 on that answer.
Okay.
I don't think the Democrats within the Senate or the House are necessarily opposed to bonus depreciation, but as with everything in our climate today, everything is polarized. So they most certainly can't be what I'll say is proponents and promoters of that. But I don't think they're opposed to the economic benefits that it provides.
Right.
And the reason I say that is because all bonus depreciation is a timing change. It's not whether somebody gets a deduction, it's just when they get the deduction. So this is one of those things that everybody understands. We're robbing Peter to pay Paul, and the government's just robbing Peter to pay Paul. So, if the pushback was, well, we don't like it because it's tax law that's taking dollars out of the government. Well, that's true, but it's not taking dollars out of the government in the future because you'll have more dollars in the future because your depreciation will lower as time goes on, right? So I do think that it can be used as a political football, but it doesn't seem to be the sticking point on why something doesn't get done when it shows up in a bill. There's certainly other components of things that show up that are much more polarized and saying, we're not voting for that. If you leave this, we're not voting for that. Bonus depreciation doesn't seem to be that political football.
Right. So an off-topic question, well, on-topic question, but wasn't something I had in mind to ask, but something that I've heard, and we'll talk about sayings here in a minute, but something that I've heard people talk about is poor man's 1031. And it feels like that could be the case when there's 100% bonus depreciation in place, where let's say I decided to sell a property. Say I already took bonus depreciation or I didn't, but I'm selling a property and I owe taxes right now on that delta.
Yep.
But in that same year, when 100% bonus depreciation is in place, I buy my next property. Can I offset that tax bill potentially with that new purchase if I qualify to recoup bonus depreciation?
So the answer to your question is actually pretty complex. So I'll try to simplify it. The anticipation should be you're not getting out of tax because you decided to do that.
Right.
The instant you claim bonus depreciation, it goes from what I'll say is a real property add back to a personal property add back within the law, which means it comes back to you as ordinary income. And what you're deferring with your 1031 is your capital gain.
Okay.
So you're not allowed to offset ordinary and capital from that standpoint. I may have some deferral that does exist in there, and I may have some benefit that does take place associated with it, but it's not going to be something that turns around and then it's like, okay, well, if I 1031 it, I don't have to pay any tax associated with the transaction because you've changed the character of what that deduction.
Right. But if you're not, I'm saying you're not actually doing a 1031, right? You're selling a property, but you're buying a property in the same year. So you owe taxes. So everyone should know that you owe taxes on that property you just sold.
Yeah.
And then in that same year, you may be able to claim bonus depreciation, which I guess ultimately on the bottom line may help you save.
That's okay. So yes, you could turn around and you could buy your way out of it 1,000%. Yeah, that would be true.
As long as bonus depreciation is in place and you're able to do that.
and and you qualify that bonus depreciation would then be an ordinary deduction for you, whether it be through short-term rental or real estate professional status. As long as that's true, then sure. If I sold the property for $1 million and I claim $400,000 a bonus, I add back my $400,000 a bonus. I go buy a $2 million property and I get a $400,000 bonus depreciation deduction. Sure, those two would offset as long as they would both qualify as ordinary. Sure, and they would in this particular example. So sure, yeah, you could do that.
Yeah,
but
something that I've
you'd have to
definitely heard
find your
people
way to
talking
it.
about in the past.
Yeah.
You know. All right, cool. So we hit that. So the other thing that I hear thrown out there a lot, and I'll let you kind of explain what it is and whether or not this is the right term for it. But a lot of people talk about the short-term rental tax loophole.
Yeah.
So why don't you go ahead and kind of tell us a little bit about that?
Sure. So again, we talked about the high hurdle of becoming a real estate professional.
Yeah.
The reason people want to do that is they want to take what is normally a passive activity in renting and turn it into an active activity so that I can offset my other income. That's the goal, right? That's the purpose.
And you're offsetting it with any potential losses.
Losses associated
like
with
if you take bonus depreciation, then you could offset that active income with that loss.
I could offset my active income, which normally isn't allowed if I don't meet that high bar of real estate professional. So if I meet it, I can offset my active income, W-2, wife's W-2, husband's W-2, whatever. I can offset those things, right? So now with short-term rentals, as long as you meet the rule book for it being a short-term rental, then short-term rental goes from Schedule E, which is passive, to Schedule C, which is an active activity.
Okay.
And then the bar and the hurdle that you must get over in order for that to count as an active business now has to meet the material participation requirements, which are significantly lower than real estate professional status. So there are 7 components to it, but there's 4 major ones, and there's 2 that pretty much everybody hits for material participation. The first one is most people hit the 100-hour test. If you put 100 hours or more into the activity and no one else puts in more hours than that, then you meet the bar for materially participating. Okay. And of those 7 thresholds that you can meet within there, you only need to meet 1.
Okay.
You only need to meet 1. So that's the one that most people hit. I spent 100 hours performing activities associated with my short-term rental. Nobody else performed more. Therefore, I meet the material participation requirements. The other one is,
sorry, not to cut you off. So it's really short-term rental material participation
correct.
Qualification is what the STR loophole is.
Correct.
Is what people are calling.
Correct.
So got that. So then let's stick on. So on the 100 hours requirement, it's anybody that's associated with my short-term rental. So if my cleaners are performing cleaning on my property more than 100 hours in that year, that means that one doesn't qualify for me.
Well, they're not trying to. So like their external allowance for anything they're doing is different than a potential deduction associated with the person that does the owning.
Okay.
So you scheduling cleaners to come clean your place would count toward your time to meet the 100-hour test, but your cleaners cleaning it doesn't count. That's something that's separate and distinct from you. This is going to be ownership, active participation within the confines of the short-term rental, management, bookings, dealing with, rent.
Cool.
If you meet that 100-hour bar and nobody else works more than 100 hours, right? So, and if you look at it, let's say you have 175 hours into it and you rent it, 30 times throughout the course of the year and it takes, 2 hours to clean it. Perfect. No problem. So like, yes, you want to make sure that you've met that threshold, and most people meet it there. And then the other one is they have like the substantially all test, which is you've performed substantially all of the hours that were necessary for that activity to exist. So maybe you don't get to 100, but you got to 75, but it only took 85 hours to manage that, to manage and function that property. If that's true, then substantially all. Now there are some other hard tests that people can get, which is the other 2 main ones, which are the hard 500-hour test. If you participate more than 500 hours, you're just automatically deemed to qualify. You are capable. I caution people to make sure that we do this the right way, and I will overly broad this, but if anybody has any specifics, we'll feel free to give them my contact info that can help them. But you are capable of getting the substantial or significant or substantial participation allowance, which is 500 hours, but it allows you to combine rental activities as one activity.
So across properties?
So then across your entire portfolio of activities, can you meet the 500-hour test that is another way that you can meet the material participation test associated with this. Now, I will caution everyone that doesn't necessarily, those rules and thresholds don't necessarily always cross over to your real estate professional process if you're trying to meet that bar.
Material participation.
They're two separate and distinct tests and bars that you're going through. So there's certainly overlap in the time and activity that you're performing, but it should not be assumed that if I met the real estate professionals, or if I'm close to real estate professional, that I automatically meet the material participation. You want to make sure that you analyze that and verify that.
Right. You're checking the box for one of these tests.
Correct.
Kris, if Jeremy and I buy a property together and we own it 50-50, are these things we need to be worried about? Or how do the hours work when there's two partners at play here?
So each of your proportionate income or loss is going to be evaluated separate and distinctly from each other. Meaning, does Scott meet the threshold? Does Jeremy meet the threshold? Same thing in a husband-wife scenario. If a husband and wife own it and the wife is a real estate professional and the husband is not, then he does not get to claim the losses on the 50% that he owns. So in your example, if you don't meet the material participation threshold, but Jeremy does, Jeremy would qualify then to be able to take his proportionate K1 ownership interest, and that would qualify for him as being an allowable short-term rental loss. Whereas for you, I don't materially participate, therefore it's a passive activity for me, and I would not be able to claim it as a loss against my ordinary income.
But do we have to compete, or these are dumb questions because I'm new at this, but if he gets his 100 and I get my 100, we each get to take our 50% benefit?
Yeah, I mean, you would definitely look at it in totality and make sure that you're meeting the threshold. But for simplification purposes, if the two of you who are the owners and you are putting in substantially all of the hours within the ownership confines and management, et cetera, then yes, we would expect you to both meet the material participation threshold under multiple tests in that particular example. In that scenario, if I'm looking at it and you guys put in 450 hours combined and the total activity was 600 hours, I'd just say they meet the substantially all. Again, the good part about the material participation piece is there's multiple ways to get there. And there are multiple, what I'll say, are more realistic ways to get there than real estate professional status.
Right. Okay. Makes sense. All right. So that explains what the STR tax loophole is when people hear other people out there say it. So I guess a couple questions continuing on Scott's idea, because we may buy a property together down in West Panama City Beach, and then our co-host management company is going to run it. Right. Okay. So ultimately we're running it, but we're running it through Auditor. No issues there with it being through a separate entity, but it's still us.
You certainly are going to have to look at, and the separate entity has, I think you're going to have to look at who's actually doing the active function, right? Are you still performing the active function, right? So even if you're flushing through ownership structure, who's performing the active function? Because the ultimate taxpayer is the one that has to meet the bar.
Right.
So the ultimate taxpayer is you, or the ultimate taxpayer is Scott. Did you meet the bar of material participation? So even if you're flushing through an ownership management company that you own, but you're still performing all of those functions and activities, did you meet that threshold?
Right.
As the owner operator of that particular.
Got it. So if we own Auditor, but say we have some virtual assistants that work for us and they handle a lot of the day-to-day tasks.
It'd be much harder to reach that bar.
Right. Okay.
Yep. So that's where you come into the 100-hour test where nobody performs more. That's where you come into the substantially all. Well, if they perform 250 hours and you perform 110, then you don't meet the threshold of, substantially all. So yes, all of those things need to be taken into account and factored in when you're going through the process of these ownership structures and making sure that they qualify. Now, I want to be very clear. It does not mean that you cannot offset your income from the short-term rental with the expenses of the short-term rental. It just means that you as a taxpayer are not going to be able to take a benefit greater than zero onto your tax return against active income.
Okay.
If that makes sense.
So standard business expense losses can be taken.
If your short-term rental makes $100,000 of rent
Mhm.
and you have $150,000 of expenses, you're always going to be able to claim 100,000 and make it zero, right? That $50,000, and whether you're allowed to put that $50,000 against other active income on your tax return is going to depend upon whether you met the material
Material
participation
participation.
test.
Right.
If you do, then you can take the $50,000 as a loss. If you don't, then the 50,000 goes and gets suspended into a bucket to offset future income from that property.
Got it. Okay, that was gonna be my next question. So it stays. Okay.
You don't lose it. You don't lose
Yeah.
it. It just goes into a bucket like a net operating loss and those kind of things. And
Right.
then where it's allowed to be offset in future years is just dependent upon what it is.
Gotcha.
Chris, earlier in our conversation, you gave an example of how the cleaners kind of don't compete or don't count as hours because I assume it's because they're 1099 or they're a separate vendor or someone like that. Is that
Well,
why?
they aren't part of the ownership group.
Okay. So then, so then I would ask the question with the VAs. They are independent contractors, not W-2 employees. They don't own part of the, any of the property or anything like that. Does that impact in a good way uh, our ability to not have to deal with those hours that they're working?
I guess I would like to say that I still believe that you don't have any issue getting there. But
Mhm.
what I'd like to know is what are they all doing and
Okay.
who is doing what? So like if you go look at what you do and you look at what they do and they're managing all the guests, they're managing the reservations, they're managing scheduling the cleaning company, they're managing what we'll say is kind of the active activity of the particular property. And you're saying to yourself, well, I manage them. Well, that's going to be a tough sell if you're sitting in front of a federal or state auditor. Whereas if you're managing a component, like let's just say they're managing, the cleaning and the repair component, and you're managing all the guest components, and then you turn around and you look at it and you're like, okay, well, I got 150 hours in it, they got 120 hours in it, I win. And I would agree with that statement. But I
Okay.
would like to look at what are you doing versus what are they doing? Because if you're not really participating in the function of that property, then it's going to be hard to say that those hours should exceed the hours of what they're doing, or like, not like their hours should not count. Now, if they're passive, like let's say, for example, your VA turns around and puts together a spreadsheet every month, and that spreadsheet is your just your ins and your outs, and they send you a spreadsheet every single month, and you're managing all of the functions of everything going on, and you're 120 and they're 100. This is a no brainer. It's easy.
Gotcha.
You know,
So as when it comes to the activity type, the types of activities, if on in Altvera, let's say my primary activity is calling to try to find new clients for Altvera, and let's say I do that 5 hours a week, and that rolls up to whatever 5 times 52. Are those hours meaningful hours that I can count towards it, or what's your opinion about that?
and for Altvera, what do you want those people you're calling to do? Like, what are they? Tell me what they
Become
are.
clients of ours so we can manage their properties. They're
So
owners, they're short-term rental owners. We would like to invite to be our client.
So I would say that the active pursuit of business within the property management world most certainly is something to consider. Now, I've talked to clients over the years, and this is kind of where it gets hard. Where it gets a little challenging is I always got asked more years ago than now. Well, if I'm out looking for property, and like how does that relate?
I
Well, I
get
guess it
that. Yeah.
depends upon what your success rate is, right? So I
Right.
would tell people like you can't go look at 35 properties and never buy one all year and then count 800 hours and be like, no, look what I did. So like the reality is you can't just go call a bunch of people or put down a bunch of appointments and never land clients and then say,
Mhm.
well, but let's say you go in there and you're making calls for 5 hours a week, and let's just say that that's 10 clients a week, potential clients a week you're calling, and then you turn around and of that's 520 potential clients, and you land 125 of them. Well, that's active improvement of my business. That's securing additional business for my company. It would be
Yeah.
hard pressed to think that that is not actively participating in the management or the management company in what you're doing because we're not expecting business to just walk through your door. You've got to
Right.
put some effort
But
in.
if it was like 10 or 15 of those potential clients became clients,
Yeah,
but we only want to have say 40 listings total.
for sure.
Like, then it's a significant number,
Yeah.
right? So it would probably be okay in that perspective. But if we want unlimited number of listings, then maybe it
A
doesn't.
1,000%.
Okay.
This is
What
one of those
seems to
things
be
where you kind of know it when you see it, right? Like
Mhm.
I'm actively making these phone calls. I'm consistent. I'm documenting them. I'm doing these things. I'm talking to people. We're adding clients as appropriate that meet, you might be calling people that you're not sure if they even meet the standards with which you want them to meet. You just know that they have properties and potentially could be looking for a property manager. Those are all reasonable things to be doing within owning a property management company to try to obtain business for that company, for sure.
It seems like the moral of the story is like the IRS is not trying to get you. They're not trying to get you as long as you're making a sincere effort. As much as we think the IRS is like, oh my God, they're going to nail us. As long as you're making a sincere effort to do business the right way, they're probably going to be fair, right? I mean,
The IRS is not trying to stop you from doing the things that you want to do or even deducting or claiming the things you're claiming. They would like you to demonstrate that that is actually the thing you're doing and you're not trying to find a way to make it active, right? So, like in that particular example, like let's use that as an example. If Scott, if you came to me and said, okay, I'm going to do this, I would say you need to document everything that you have on your calendar so that if the IRS ever does show up, we can print your calendar and be like, here's the phone calls that I made every single day. Right? And if you need me to, I'll go print out my cell phone bill or my office bill. And I'll show you that I was making these phone calls. And by the way, here's the 40 clients that we added that particular year. So like if you can show the progression and function of operating a business, sure, it's not going to bother you about the fact that
you can add those hours.
220 hours doing it, right? But it's again, like it's the ones that are like, well, I went and spent 850 looking at property this year. Well, did you buy anything? No.
Right.
Like it's like, okay, well, that doesn't really pass the sniff test of
the hobby of driving around.
Yeah. That's a hobby. That's not an active business, right? Because no one that's trying to make money to survive would do it that way.
Right.
The way you're describing, yes, that's how I would operate a business in order to have it be my livelihood.
Yeah, that's awesome.
That's kind of whenever I would go in and audit somebody and business versus non-for-profit type organization is kind of what was kind of the feel and look. How they describe to me what they did within the business is very important. And I'll use an example. I actually was out last week on an audit. Someone got audited. A buddy of mine's client got audited. He asked me if I'd be willing to help him out. And the business versus not-for-profit, meaning I'm not actively pursuing a business, that was one of the items that potentially could come up. And the client did a really nice job of describing everything that he has his fingers in within all of the organization, right? So when I met with the auditor after that initial meeting, she just said, it's clear he's actively involved in every single thing that goes on here. So whether he met the letter of the law, it didn't come down to prove to me how many hours, prove to me where this was this, prove to me. He sat there and described, well, this is what I do here, and this is how, and this person goes over here and interacts, and then all the folks come to me here, and he's describing kind of the flow of how these businesses operate and intersect each other, et cetera. And she just moved beyond that really being a concern for her. It didn't come prove it to me, letter of the law, issue. It became clearly he's participating and doing the things that
he's an active member.
Right. So what I'll say is I don't know that you're ever going to have to necessarily prove it if you can demonstrate the intersectionality of everything you're doing and that it makes sense with what your business is.
Right. When it comes to an IRS auditor, I don't know why this came up, but since you have so much experience in it, is the nature of an audit, does an auditor get rewarded, compensated for winning an audit? Or how does it work where from our side, we'd be like, wow, he's really unfairly digging into things and he's trying to catch me with, could you just kind of comment on that?
You get absolutely nothing, whether it is a refund audit, a no change audit, or you would never, ever want to put IRS agents in a commission environment because I promise you, I mean, every audit I was on, I could find something that would have been an adjustment. You would never want to do that. So the direct answer to your question is there is no benefit associated with an auditor finding something that results in the government collecting money. There is also no detriment if it's a refund. I used to start all my audits out with, I don't actually care how this goes. Okay. I don't care if you owe money. I don't care if you get a refund. I don't care if we don't change anything. That's not why I'm here. I'm here to find out that everything seems to make sense. So you never have to worry about that. Then it comes down to, I always said there were really only two types of auditors. There are auditors that are good and reasonable or trained and unreasonable. Okay.
Sure.
So I always seem to find the ones that have had careers outside of the government or jobs outside of the government associated with accounting, tax, business, whatever, take your pick,
More experience.
and then came to the IRS, seemed to be able to be a little more reasonable about the application of how things are going to go versus someone who was trained by the IRS from the moment they started their career and then was in or within the function of government their entire careers. They seem to be a little bit more rigid. Now, good or bad, that just was my experience over the course of 7 years. So when you run into the trained and a little more rigid type auditors, yeah, it becomes a fact-finding mission. And they're going to make you find and prove and everything. Whereas the other auditors, which I will tell you, I think are more in abundance than the trained and rigid ones, are, give me something reasonable. Give me, help me fill in the holes of the story that your tax return tells me don't make sense, right?
Yeah.
So I'll give you an example on my side. I went in for an audit one time and I walked in and I just asked one question. He put himself down as a professional angler. And I just said, every person I know is a professional angler. Why are you different? Like every person in my family that fishes considers themselves a professional angler. Why are you different? And he spent the next hour showing me lake maps, trip receipts. Things he would just go and he's not even fishing, but he's just mapping out the topography and whatnot of the lake. And he's finding holes and he's doing water temperature readings and he's showing me all of these different things. And when we got done having the conversation, that's the reason why he's a professional angler. And Joe Blow down the street who goes fishing every weekend is not a professional angler. So, like that's a reasonable conclusion for me. I never asked him, prove to me how many hours you do it. Show me that you do X, Y, Z. Prove to me that this is your business and you don't do anything else. He described the story, provided me with reasonable information. Again, he pulled the maps out and he pulled out the receipt, the trip receipts, his mileage log, all those things. Well, that all made sense to me. And the reason why he was being audited is because he bought a boat every year.
Yeah.
Right.
Yeah.
Well, the reason he buys a boat every year is because they double his winnings if he wins, if his boat's 2 years old or less. Right. So that story made sense and then had some documentation behind it. So we moved on from whether or not he's professional and just started auditing whether or not everything on his return made sense.
So when it comes to an audit, like the career of an IRS auditor, you were there for 7 years. I'm like kind of curious. Do you feel like you survived your time there, or is that a career that people seek out because they enjoy it? Like, what an IRS auditor there, are they enjoying their career, or just tell me how that works, that kind of thing?
No one today is enjoying their career.
Okay.
I think what the IRS is today is certainly not what it's been historically. I will tell you that was probably my favorite job.
Wow.
Because I really did enjoy the interaction with people part, and it never had to be combative unless they wanted it to be combative, which I'm fine with. It doesn't bother me. If you want to have it be some certain way, well, then fine. I can sit there and it can be that way. But I would always tell people like this doesn't have to be awful. I'm not here to try to get you. This is just a function of the job. Here's why you were pulled, blah, blah, blah.
Gotcha.
So I don't think a lot of people are enjoying what working at the government and the IRS means today. But it is a good job that's a solidly paying job that is certainly needed within the function of our current system. The several or few people that I still know that work at the IRS, I wouldn't say that they're jumping out of bed every morning ecstatic to head to the office kind of thing. I think there's some challenges that get created in our political climate. The funding has certainly been an issue, and they certainly have lost. I started at the IRS in 2009. I don't know the numbers off the top of my head, but I would not be surprised if the IRS was smaller today than it was in 2009.
Right. Yeah, makes sense.
From both total people and budget perspective.
Yeah, I'm hopping on and off mute here. I think I've got a fan noise coming from my computer. But if you don't mind, let's switch to that second part of today's topic and bonus depreciation, and just kind of maybe explain what it is. How is it kind of calculated, right? Because you're pulling depreciation up front. You answered a question earlier where if you don't take it or you can't take it all in year one, but you pulled bonus depreciation, then how is that pushed out? Like, what is the advantage of actually doing it if you can't take it all in year one? If that makes sense.
If you can't take it all, but you qualify, is that the question?
Yeah.
Okay.
Right.
So bonus depreciation allows you to take what would normally be, say, a 27.5-year residential rental deduction period or a 39-year commercial deduction period, and accelerate a portion of that based on the useful lives of the depreciable lives of the assets within, and I'll describe that in a minute, and allows you to push it into year one. Okay. So all 5-year, 7-year, and 15-year property is allowed to be depreciated in year one. Landscaping, for example, a lot of exterior work, all those kind of things.
And
so
sorry, those years are the depreciable years of that specific item.
So yeah, so like let's just say I owned a building and I went and I did some outside activity or outside work to the property, not on the building itself, did some a substantial repair on something outdoors. Well, generally speaking, that I'm not saying it all qualifies this way, but generally speaking, that's a 15-year asset, right? So 15-year assets are allowed to be deducted in year one, 5-year, 7-year, 10-year, 15-year, right? What happens is you hire a company that will do cost segregation study for you. Cost segregation says, if I look at this building, how much of this building qualifies as 5-year, 7-year, 15-year, and call it 27.5-year. And they'll go through and they'll analyze the components of the building. They'll look at it, they'll evaluate it, and they'll come up. Let's just say roughly those percentages range somewhere between 22 and 35%, depending upon the building. So to put it simply, let's say you buy a property for $1.2 million, the land's worth $200,000, the building is worth $1 million. Company comes in, evaluates you and says, hey, 25% of this property qualifies for 5-year, 7-year, 15-year treatment. We've broken it down, all the components. Awesome. That means that you get a $250,000 deduction on your tax return that you would be able to take against that property in year one. So if my rent is $100,000, and let's just say this is my only expense, $250,000, I would have a loss of $150,000. Okay.
Makes sense.
As long as I qualify through the short-term rental, material participation rules, the real estate professional status rules, if that's the route I'm going, as long as I do that, then I can take that $150,000 and I can use it against other active income on my personal or my joint return. I can use it against other active income. Now, let's say I have a $150,000 loss, but my other active income is only $100,000 and I have $50,000 left. That now goes into a pool that can be used in future years against my income.
Makes sense. Yeah.
So let's take it and extrapolate it in a little more real life example. Someone buys a $10 million property, a $12 million property, $2 million of it is land, $10 million of it is building. Same example, 25%. That means I'm getting a deduction for $2.5 million. Well, my income is $250,000. Obviously, I have a ton left over that is going to sit in my net operating loss pool that can be used in future years. So you don't lose it. You just get to use it in future years. And again,
if you owe taxes or have back taxes, can you apply it to that or no?
Back taxes, no. Back taxes, you cannot. Any current liability that you would have, you can offset your income and you would expect that your liability would go away. Now, keep in mind, this is income against that is active. You can't turn around and offset things like capital gains and other things with this particular income because this is ordinary income. So you still have the same thresholds associated with types of income that can end up being taxed. It's not going to necessarily always get you out of, if you were to owe self-employment tax, for some reason. And like that. So I'm not going to say in every circumstance, everyone's liability in that example is going to go perfectly to zero, but your ordinary income is allowed to be offset by the amount of the loss that you generate that qualifies to be used against it.
Okay. So I guess to try and bring this all into a bow for what I hear about a lot in the short-term rental industry is somebody wants to buy, let's say somebody with a high W-2 wants to buy a short-term rental and they come to Auditor and say, I want you guys to manage it.
Yeah.
There's probably no chance that they can then materially participate if we're managing their property. Correct. To take that bonus depreciation all in year one. It would have to go against other passive loss. It couldn't extend to their other passive income. It couldn't extend to their active income.
They're most certainly going to have to find they're certainly going to have something else going on in there that would tell them that they would qualify based on the material participation rules. That's correct.
So if somebody were to come to us and say, I'm buying a property in 2026, no matter when it is in the year, and they said, but I want to be able to take the bonus depreciation to offset my W-2, we could still potentially manage it, but they would have to take one or more aspects of managing that business and put in, I guess, more hours than us, and or just, I guess, achieve the 100 hours or the 500 hours or whatever those markers are. They would have to do that in that first year to be able to take that bonus depreciation off against their active income, their W-2. And then in year 2, we just manage it 100%.
Sure. I agree with you that these are separate and distinct events, meaning year 2 doesn't have to look like year 1. There would have to be some substantial good faith capability to prove that they weren't just doing that for the sole purpose of claiming the bonus depreciation. Sure. And the IRS would be able to come in and most certainly challenge that and say, well, your intent here wasn't necessarily the reality of what you did. So
what would be submitted in year 2, I guess? Because if they took it all, then they're just taking, I guess, regular depreciation or whatever is left to take.
Sure.
In year 2.
Plus all the
yeah. Would there be anything that would be submitted to the IRS to say, okay, I did 500 hours, or I did 100 hours, or I did 120 hours, and Jeremy and Scott did 100 hours? Like, is there anything that would get submitted in year 2? Yeah. So technically it can happen, but what you're saying is the IRS doesn't want that. They don't want to see you all of a sudden.
So tax planning is not tax evasion. Okay. So there's nothing wrong with tax planning. But if I'm not saying that the IRS would win the issue. I'm just saying you would better be able to wrap that together and have a good explanation, documentation, everything associated with that to try to sustain that issue should someone get audited. Because if the IRS comes in and says the substance of what you did was just to avoid tax in year 1 to generate this big loss, but the actual reality of how you're managing this property has nothing to do with you, they most certainly would have an argument to come in and say, well, that's fraud, right?
Yeah.
It doesn't necessarily mean it's fraud, but I mean, they would certainly have an argument to say, hold on, that doesn't make sense. You didn't buy it to manage it. You just managed it for 6 months because it meant you got a $200,000 deduction. Now you're just pawning it off the last 5 years. You've done nothing, right? Why didn't you do nothing from the beginning? Oh, because I have the ability to do this, right? So, so like what I would caution people against is like, don't make up a reason to get it. Use the function of the purchase and the property, et cetera. Like if you're not going to plan to manage it, well, don't try to make up a reason to get a huge deduction, because the likelihood of sustaining an audit is probably under 50%. But if you are going to participate and do it, well, then just meet the threshold. Just plan to meet the threshold. So I don't disagree with you. There is nothing that is submitted. However, in year 1, it would have been active income. And in year 2, if it's a loss, which it probably would be in year 2 still, it's going to be passive income. So that's the thing that the IRS would say, it's active year 1, passive year 2, what happened? Right.
So it's on the different schedules. And
it's treated differently on our tax return. The algorithm of electronic matching is going to tell them that the treatment of that is different. So whether it gets picked up, I don't know. But I don't know that if I'm sitting there representing someone or talking with the IRS to say, well, why did they do this in year 1 versus not year 2? I don't know that I have a better reason than, because they wanted bonus depreciation.
Right.
We want to have a reason.
Yeah. All right. So that makes sense. So it's two last parts here. So essentially it's going to be very challenging, next to impossible, for somebody to come to us and say, I'm buying a property, you're going to manage it, I want bonus depreciation to offset. It's not going to happen. Like, you really need to think about this holistically. If you're buying a property, that like you're managing this property, if you want to be able to take that in the eyes of the IRS, you want to take it, you're continuing to manage.
If you're going to think about it through the eyes of an auditor, then yes, you need to think of it as certainly a longer term situation than just, I bought it and now you take it over next year.
Yeah.
I'm not saying that if someone has a short-term rental, if Jeremy has a short-term rental and you've rented it for the last 3 years, you've managed it, you've done everything, you claimed bonus depreciation, you did all that, and now you have 10 short-term rentals and you're like, screw this, I'm hiring a management company. I'm not telling you can never hire a management company, but that's an easy conversation with an auditor. Well, now he has 10 and he can't manage them anymore. So he hired a management company. So any of them going forward, he may not qualify because he may not have enough time within the function of his property. So it got too big. Whereas a lot of people in the example you're talking about, it'll be like, I'm buying 1. Oh, I have 2. And so like just getting to 100 hours or 150 hours, whatever, not a stretch, but it certainly becomes a process. And now I'm hiring a management company the next year. Like, it just doesn't pass the sniff test.
So Kris, and that totally makes sense.
Kris, I hear way too many real estate agents, way too many investors, really more real estate agents, like encouraging people to buy the property, do 100 hours before December 31st, and they get all the benefits of what we've been talking about. And
Yep.
then the real estate agent then sells them the house and they encourage them to get a property manager on January 2nd. Like,
Yep.
what is your reaction to that?
I think you probably lose it on audit, right? I think you probably lose it on audit. If you look at statistically the likelihood of getting audited, I mean, it's a risk-based assessment for people, right? It's a risk-based assessment. But the fact that that's what they're doing should tell us, well, maybe it doesn't quite pass the eye test off the top, right? Now, I'm not saying it doesn't happen. I'm not saying people don't do it. I'm not saying you can't get it sustained on audit if you really pay attention to what you're doing and document. I'm not saying that. But we can all agree that at a minimum, if you had to sit in front of somebody and explain it, it's not the easiest explanation to come up with a business reason why you did it.
Yeah.
There'd probably have to be a big change in your work or something that popped up that's like, "No, this happened. Clearly, I couldn't manage this anymore. I planned to, but
1,000%.
a new role and I'm traveling, whatever."
And like
Yeah.
you said earlier, clearly the only reason why you bought it was to qualify for the money, to get the tax.
1,000%. Yep. And so like,
So,
and there's no skin off the real estate agent, from that standpoint, because they're not telling them anything that isn't true. It is true that if you meet the material participation threshold, et cetera, where I think the error happens is like, okay, buy it in November, or buy it in October, get your 100 hours in, and then I'm setting you up with this guy, go meet with him or gal, and they're going to go ahead and get you managed starting January 2nd. Like the whole plan was to just go get the deduction. Well, you're not going to win that. Okay.
Right.
You're not.
And I think that's kind of, I think, the misconception that is out there a lot of the time is, you're getting close to the end of the year, buy it, manage it, end of the year, swap it over to your property manager. So one last question, selfish question. So let's say we have a client who comes to us and says, "I'm buying this property, you're going to manage it. I'm telling my accountant that I did all these hours. Maybe they didn't, to try and get it." Any implications towards us if they get audited?
No, not necessarily, as long as everything's done in good faith, right? Everything's done. We're trying to manage it. We're trying to do what we're doing, et cetera, et cetera. Like, I wouldn't worry about it a ton, as long as your advice, your activities, all those kind of things, everything seems to make sense. Not an issue at all. Nope.
It sounds like, Kris, the blame belongs on the person trying to get tax benefits rather than
Of course,
somebody.
because they're the ones claiming it, of course. But I mean, there are ramifications down the pipe if they're being given bad advice by people that should know better, et cetera, et cetera. Sure. But at the same time, we definitely have to make sure that, we're providing people with some at least reasonably sound guidance.
Yeah. So, Kris, I know we told you a max an hour on this thing, and we're getting pretty close. So I really do appreciate you taking the time out of your busy day to kind of run through this with us. I think I learned a lot, and the advantage I have now for this is I don't have to call you when I forget. And have you go through it all again. I can just listen to it. So
There you go.
Appreciate it. What's the best way for people to get in contact with you if they're looking for your services?
I would say to shoot me an email at kbeck at that's KBECK at KASconsultants.net, and I'd be happy to help and guide in any way, shape, or form that they might need.
Awesome. Great. Scott, we can throw that, I guess, in the show notes, right? People can get
Yeah,
it.
we can throw it in the show notes. Kris, thanks for joining us. We appreciate it.
Hey, no problem. You guys have a great day. Really appreciate the opportunity.
Yeah, you
course.
too. Everybody, we'll see you in the next episode.
Sounds good.